Stock markets, in their simplest forms, are exchanges that allow investors like you and me to buy and sell stakes in listed companies. You see, the stock market is the center pillar of this channel because we find it to be a consensus guide for how good or bad a company or a country is doing. After all, the numbers never lie, except for Enron's, of course.
No, God!
And we can thank the stock market for propelling household names like the Microsofts, the Facebooks, the Amazons, the Teslas into the multi-billion-dollar giants they are today. We also have to thank you all for smashing that like button.
Smash, smash,
and propelling the Momona Report to the top of the YouTube algorithm. And it's important to know the stock market can be as ruthless as is it rewarding. Let's pay our condolences to the companies that may have been the kings of the stock market of their time, but sadly now live 6 feet under. You know, like Joffrey.
I am the king!
But why do stock markets crash in the first place?
Why?
While it can be terrifying, it is natural for stocks to correct, sometimes worse than others, but it is simply part of the game. Stock market corrections give stocks a chance to recalibrate and adjust valuations that may have gotten unsustainably high due to speculation or other factors.
A very bad day in markets. We want to get our final thoughts on this Monday, and as some are calling it, a new Black Monday. The Dow today fell by 13%, S&P down 12%, and the Nasdaq also fell by 12%.
For this video, we have compiled its top 7 most devastating stock market crashes in memory, where many of them led to massive unemployment, agony, and even suicides. We have excluded the non-stock market crashes like Tulip Mania and the South Sea Bubble because, quite frankly, those deserve a video of their own. We have also excluded the 2020 market crash caused by the global pandemic, as there are reasons to believe that the damage is not over. But before we start, don't forget to smash the like button and subscribe to enter this month's prize. Number 7. The Chinese stock market turbulence of 2015.
China.
After a few years of being one of the fastest growing markets on earth, China's stock market collapsed on June 12, 2015, and then again on the 27th of July, and then again a month later on the 24th of August. And despite the Chinese government's attempt to stabilize the market, the chaotic panic selling wiped more than $3 trillion worth of value in just 3 weeks, almost 30% of the market's total market capitalization, as fear of complete market seizure and systematic financial risk grew across the country. And moreover, the surprise devaluation of the Chinese yuan on the 11th of August and a weakening outlook for the Chinese growth are believed to have been the causes of the crash, that also put pressure on other emerging countries. Number 6. The stock market crash of 1987.
Today is Black Monday, the day the Dow dropped more than 500 points.
Things leading up to October 19, 1987 were booming, as this was the age of high leverage corporate mergers and takeovers that also introduced the highly speculated financing tools like margin accounts and junk bonds, making things even more juicy for investors with the IPOs of technology companies, ultimately putting companies and investors in high leverage situations.
Wall Street's bull market continues to surge upwards. The remarkable 5-year-long spree has catapulted the Dow Jones Industrial Average from 777 points in August 1982 to a record 2,722 points in August 1987.
You see, the idea of leverage was yet to be fully understood by everyday traders or investors, but the short-term availability of extra cash dominated the buyer's stock market. And soon enough, the same buyer's stock market collapsed. Panic selling consumed investors as more and more began to sell. But what made things worse is that at the time, it was electronic trading. Although revolutionary and extremely efficient, computer trading made it easier and faster to sell. And after a shocking 23% drop in one day, it seemed that decision makers finally learned their lesson and introduced circuit breakers into the market. This aimed to halt trading at certain milestone percentages in order to give the entire market a chance to breathe, recalibrate, and limit extreme, uncontrollable sell-offs. It wasn't bad for Paul Tudor Jones, however, who netted $100 million shorting the market that day. That's about $230 million in today's market. Number 5. The dot-com crash of 2000.
Amazon, which went from around $100 during the bubble peak all the way down to $7 after it burst.
Oh wow. If there was a time I wish I could go back to, it would be the early 2000s. Let me know in the comments below what time do you wish you could go back to, when stocks were cheap at least.
But with low inflation, low unemployment, low interest rates, strong corporate earnings, I would be a certifiable lunatic if I said the market was going to crash.
The dot-com bubble or the internet bubble was due to heavy optimism in internet-related companies. Just put a dot-com next to your company and boom, you're a millionaire. Sometimes even a billionaire, just ask Mark Cuban. The Nasdaq, an index made up of mostly tech companies, grew 400% in 5 years, with some individual stocks doing 1,000, 2,000, sometimes even 10,000%.
Overall, the Nasdaq grew from 1,000 points in 1995 to over 5,000 points in 2000.
But in 2001, this tech bull run came to an end. From March through to October, the Nasdaq dropped a heart-stopping 77%, crushing most dot-com stocks as it fell. But the general optimism was probably not misguided. I mean, this was the time that Jeff Bezos came up with Amazon after all.
Web usage was growing at 2,300% a year. So I decided I would try and find a business plan that made sense in the context of that growth. And I picked books as the first best product to sell online.
But as many investors learned the hard way, it is probably not a smart idea to invest in high speculative stocks just out of FOMO, without any fundamental analysis, because that's breeding ground for bubbles. And just like Anna Greenspan once said it, irrational exuberance. Number 4. The Panic of 1907.
It was really the panic of 1907 and the subsequent crisis in 1908 that led to overcoming the political reticence to a central bank.
The Panic of 1907 was a 6-week stretch of runs on banks in New York City and other American cities throughout October and early November of that year. In fact, the New York Stock Exchange fell 50% from its all-time highs. It was triggered by a failed speculation that caused the bankruptcy of 2 brokerage firms who tried to corner the copper market. That sounds like Lehman Brothers in 08 with the housing market.
But what I really want to do is I want to reach in, rip out their heart, and eat it before they die.
But actually, the shock that really kick-started the panic was the earthquake in San Francisco in 1906. This created a liquidity crunch that created a recession starting in June 1907. But despite the massive stress to the system, the New York Stock Exchange remained open, largely because of the legendary actions of JP Morgan, who collected cash from large financial and industrial institutions and then had it delivered directly to the loan post at the exchange to support brokers who were willing to extend credit.
He pointed to the contract and said, "Here's the place and here's the pen." Completely exhausted and beaten down, the president signed and the others followed. The trusts had agreed to contribute to the $25 million pool. Within days, the economy rallied.
You see, the Panic of 1907 was the first worldwide financial crisis of the 20th century. The panic's impact is still felt today because it spurred the monetary reform movement that led to the establishment of the Federal Reserve System, the money printer itself.
Debt to GDP ratio is out of control. Who's going to pay for it?
Haha. Money printer go brrrr.
Number 3. The Stock Exchange Crash of 1873.
Reckless overbuilding on the Northern Pacific Line had already brought the railroad to the brink of ruin.
About 147 years ago, the Vienna Stock Exchange crash of May 1873, triggered by uncontrolled speculation, caused a massive fall in the value of shares, even triggering a depression.
Within days, the entire national banking system had collapsed. And once the reign of misfortune began, it didn't stop.
At the time, the National Bank was not able to step in and provide support because it did not have enough reserves available. In fact, the crash put an end to economic growth in the monarchy and affected the wealth of bankers and some members of the imperial court, as well as the imperial family itself. It also led to a massive drop in the number of the Vienna World Exhibition visitors. The crash triggered a depression from Europe all the way to North America, from 1873 to 1877. a full 5 years, giving it the nickname the Long Depression. Number 2, the financial crisis of 2008.
No idea! He has no idea!
Kramer.
I have talked to the heads of almost every single one of these firms in the last 72 hours, and he has no idea what it's like out there. None!
Still recent in the memories of all of us, the 2008 financial crisis was triggered when large amounts of housing debt started going bad. You see, the 2008 crash took out nearly $8 trillion in value between late 2007 and 2009. In October 2009, the unemployment in the US hit 10%, leaving millions jobless. Americans lost a shocking $9.8 trillion in wealth as home values hit rock bottom and many saw their retirement accounts wiped out.
With the housing market in a state of collapse, Pella's just put some employees on a 4-day work week.
And after all, these were tough times to say the least. Very few had positive outcomes from the crash, except for the likes of Michael Burry, the famous investor who bet against the collateralized debt obligations tied to the housing market, netting hundreds of millions of dollars. His story, like others who shorted the market, was part of the famous movie The Big Short.
My math specialist, look at him. You notice anything different about him? Look at his face. That's very racist. Look at his eyes. I'll give you a hint. His name's Yang. He won a national math competition in China. He doesn't even speak English. Yeah, I'm sure of the math.
Number 1, the stock market crash of 1929.
Wall Street economy disconnected from the underlying real economy and became a speculative bubble.
The stock market crash of 1929 was one of, if not the worst in US history. The overconfidence in the stock market investments during the Roaring '20s created an investment phenomenon we are all familiar with today, a bubble. And as we know, bubbles eventually burst, and the bigger the bubble, the bigger the burst. On October 29, 1929, the Dow Jones Industrial Average fell by a massive 12.8%, setting in stone what is known as Black Monday, one of the worst drops in US history, thanks in part because it kick-started the Great Depression. And understandably, it took a toll in investor confidence on Wall Street. The market during that period, after all, dropped a staggering 88.7%.
Stock prices plummeted cyclically across the board, spurring the rush of sell orders from terrified speculators. Still more.
You see, the Great Depression that derived from this was the worst economic downturn in the history of the industrialized world, and it lasted from 1929 to 1939, 10 years. And after the crash, consumer spending and investment dropped massively, causing steep declines in industrial output and employment, as failing companies laid off workers. However, it wasn't too bad for the likes of Jesse Livermore, who netted $100 million shorting the 1929 crash, an equivalent of $1.5 billion today, making it possibly the greatest trade in history. You see, there is money to be made out there, even in times of extreme doubt and fear, but make sure to invest wisely. And do let us know in the comments if you think there is another crash coming in 2020. Looks like Warren Buffett thinks so. And if you like these topics, like this video to show your support and smash the subscribe button for more videos. The more money, the more problems. Thank you, stay safe.